I'm going to go through some of my most unpopular beliefs about investing. A lot of you guys are not going to agree with what I've got to say, and I think that's good because you always want diversity of thought. Now, this goes without saying, but do not take this video as a fact before you do your own research. The stuff that I'm saying is literally my belief. It is just an opinion, as the title of this video says. And of course, this video is not financial advice. So feel free to disagree and let me know why. Let's jump into number one, which is diversification will lower your returns. Now, I know when it comes to traditional personal finance advice, all the books and podcasts and YouTube videos, basically everything tells you to buy an index fund and diversify as much as you can because diversification is the key to investing. So basically you can protect yourself against risk in case the market goes down and stopping your portfolio from completely tanking. And even on online forums, everybody talks about the goodness of diversification. However, I have barely ever seen someone in these forums or books or all these videos talking about the fact that diversification will actually lower your returns. I wish there was more emphasis on this because this is true as well, and I just want people to get the full picture. Obviously, diversification is the standard advice for most people, but it's important to point out the facts. Because if you're investing and you accept a lower level of risk, then by virtue of that, you will be getting lower the returns. In fact, one of the best investors in the world, or the best investor in the world, you could say, Warren Buffett and Charlie Munger, say the same thing.
The students of America go to these elite business schools and law schools, and they learn corporate finance the way it's now taught, and investment management is the way it's now taught. And some of these people write articles in the newspaper and other places, and they say, well, the whole secret of investment is diversification. That's the mantra. They've got it exactly back-assward. The whole secret of investment is to find places where it's safe and wise to non-diversify. It's just that simple. Diversification is for the know-nothing investor. It's not for the professional.
And there's nothing wrong with the know-nothing investor practicing it. It's exactly what they should practice. It's exactly what a good professional investor should not practice.
And this is exactly why my portfolio isn't fully diversified. I like to keep a mix of concentrated positions as well as diversified positions as well, so I can try to get a better return. I've got to deal with increased risk, and to be honest, I'm completely fine with that because now I have the potential to potentially get an outsized return more than the market, hopefully. All I'm saying is diversification is not a bad thing. Don't think I'm saying that diversification is horrible, don't do it, but just keep in mind that there are other alternatives that exist as well. Over diversification is bad too because after a certain amount, the more securities or the more stocks you add to your portfolio, the less of an effect it's going to have to your overall diversification. An example I'll give you guys is ASX VDHG. This is the Vanguard Diversified High Growth Index ETF. Now, if you go to forums or watch videos online about investing in the Australian space, you'll definitely hear of this investment. Literally everybody loves to talk about it. Everybody likes to pitch this investment as the all-in-one solution and how it's so diversified and how it's so set and forget and all that stuff. This ETF tracks around 17,000 stocks around the world, not just Australia, but in emerging markets, in developed economies, bonds as well, and so much more. So it's extremely diversified. But then it begs the question, is it really worth it to have that many stocks in a single ETF? And are they even making a meaningful impact on your investing? Let's find out. So basically, I found this post from this guy called J Hutch 2147, and this person has basically listed down all the 17,000 stocks in one spreadsheet, and the results shocked me. So this is a spreadsheet that this guy has created, and you can see that about 50% of the holdings of this entire ETF is only made up of about 160 companies. And the rest of the 16,840 companies are making up the rest of the 50% of this portfolio. Just let that sink in. So for an ETF that has 17,000 stocks, only 160 of those 17,000 stocks are driving 50% of the returns, which makes me think the rest of the 16,800 companies, are they really having that much of a meaningful impact on your investing? And is it even necessary? Because 17,000 stocks in an ETF sounds extremely good on paper. You look at it and you think, wow, this ETF is extremely diversified. but is it really having that big of an impact? In my opinion, I would say that this ETF is over diversified, and I'm sure a lot of people out there that are much more smarter than me will disagree. So let me know why, and let me know why you invest in this ETF. Also, apparently the top 3 holdings of this ETF are CBA, BHP, and CSL, and these 3 companies make up around 7.5% of this ETF's performance, and the rest of the 16,900 stocks are driving 93% of the performance. So, majority of the performance is coming from just these 3 companies which are based in Australia, while the tech giants like Apple, Microsoft, and Amazon, which have had an extremely big impact on the world, are much less than that in terms of weighting. So yeah, make of that what you will. I just don't like the way that this ETF is structured in terms of its weightings towards certain markets. Also keep in mind that this spreadsheet is from a while ago. It is about 1 to 2 years old, so these weightings may have changed. But looking at the numbers, VDHG does seem to be underperforming by quite a lot. As you guys can see, the return from 24th November 2017 has been around just under 10%. But if we look at an ETF like IVV, the return since 24th November has been around 74%. And if we go to the ASX 200 ETF, which is STW, as you guys can see, if we measure it from 24th November, the return has been around 13%. But of course, this analysis doesn't even include dividends, so of course the returns are going to be different. We're just looking at capital gain, but you can already see the difference. And I feel like this is why diversifying too much can actually lower your returns, but let me know what you think. Unpopular belief number 2, investing all of your money into Australia is a bad idea. Now don't get me wrong, this is a great country. Australia is truly an amazing place to live in. But from an investment standpoint, I'm gonna try to convince you on why it may not be the best idea to put everything in here. When it comes to our stock market, roughly 50% of it is just financial services at 27%, and then you have materials at 21%. So if you just round it up to 50%, this is essentially the makeup of our stock market, 50% towards banks and mining companies. So what that means is that you're relying on these 2 sectors to drive your returns moving forward, which is quite risky because these 2 industries don't seem to innovate as much as the other industries out there. Investing in Australia might feel safer because you've known these names your entire life. You've known NAB, CBA, Westpac your entire life. BHP and all these other mining companies, you've grown up with them. So it might seem safer, but it is a big bet. Of course, you'll be getting dividends and franking credits quite a lot from these 2 industries, but it is still quite focused and it is a big bet. There's a thing called home country bias where you tend to favor companies from your own country as opposed to companies overseas. So that might be at play here, so keep that in mind. Also, our stock market represents around 2% of the global share of the stock market, which means that by only investing in Australia, you're essentially ignoring 98% of what's out there, which is quite risky. And this is why majority of what I invest in is not Australian, it is majorly overseas, because I feel like that is where all the innovation and growth will come from. Okay guys, so I've just realized that I've got an extra 20 minutes worth of footage left to edit. This video was gonna be extremely long, so what I will do is I'll upload a part 2 next time. So for this one, thank you for watching, and I'll see you in the next one, guys. See ya, bye. VDHG, which